John Samuel, Group Head of Social Performance and Engagement at Anglo, who leads a team responsible for the development of policies, strategies, programs, guidance documents relating to the company's host communities and liaising with external partners, so very relevant. Also an associate at the University of Cambridge Institute for Sustainability Leadership. We've got Daniel Litvin at the end there, CEO of Critical Resource, which is an advisory firm helping companies to manage political stakeholder sustainability challenges in both the energy and the mining sector. Former McKinsey consultant and research fellow at Chatham House, and interestingly, for me at least, started a career at The Economist, which is one of my favourite magazines. We've also got Ellecia, Saffron, who's a founder and MD at Maysaffron, a strategic research and advisory boutique focusing on natural resources and disruptive industry, and prior to that, a portfolio manager at Abu Dhabi Investment Authority focusing on the mining space, and equity analyst at Macquarie Bank. And last but not least, Ignacio de Calonje, I hope I got that one right. Principal Investment Officer, Infrastructure and Natural Resources Department at the IFC, responsible for their Western European-based clients in oil and gas and mining sectors. And before that, worked for Lehman Brothers Investment Banking Division, which we won't hold against you.
That's fine.
In terms of the topic today, we're sort of very much thinking around how the industry can collaborate better with governments and other stakeholders, which in our minds really enshrines the social license to operate, which the notion of which has really become embedded into the extractive industry's lexicon in recent years, and for good reason. Its importance has really been highlighted this year with some of the high-profile problems experienced by companies like Acacia or Barrick in Tanzania with the Bulyanhulu mine, BHP's extended strike at Escondida in Chile, or indeed by Freeport and Rio's issues in Indonesia with Grasberg. So we're really going to be thinking about social license to operate in quite a holistic sense, covering environment, safety, economic, and governance factors, both at the federal and the local stakeholder level. Obviously, each of these is important in gaining and indeed sustaining a company's license to operate, which is pretty critical to getting the resources out of the ground. So, given that I've used the word critical and resource, I'll start with you, Daniel. Daniel, how would you advise companies and investors to assess and measure license to operate risks?
Thanks, Tom. It's a good question and good to be on this panel. So critical resource, in a sense, the answer I give will be coloured by what critical resource is trying to do, which is trying to make much more systematic the assessment and management of license to operate risk. In our view, while the industry as a whole recognises the importance of license to operate and ESG issues on a rhetorical level, that you won't find an executive, it will be hard to find an executive in the industry that says that the license to operate isn't important. But in our view, in general, or often, the industry takes a somewhat ad hoc, somewhat impressionistic view of the license to operate. For example, when a company is considering acquiring an asset, the sort of due diligence that it might do on the commercial or geological or technical aspects of the project will often be much more rigorous and much more in-depth than the due diligence that it will do on the license to operate. So we've now, as a company, now worked on or analysed, it's coming up for 300 mining and oil or gas projects around the world from the perspective of the license to operate. And I know this is perhaps a subsequent question, but there are errors that are often made in that assessment by assuming, for example, that the national political risk is correlated with the local license to operate risk, by assuming that you can do this due diligence at a late stage in the transaction due diligence process, etc. But in general, I think my view would be this whole area needs to be much more rigorous and systematic than it currently is.
Well, perhaps thinking a little bit about some of the mistakes companies can make. John, you're sort of very much involved at a practical level in this. What would you consider to be the biggest mistake that companies make when assessing license to operate?
I'm not sure there's one single mistake that, I think there's a phrase, isn't there, that happy families tend to be happy in the same way, but unhappy ones tend to find multiple ways to be unhappy. And I think that's true in this space. So I think, a common one that we still see quite often, actually, surprisingly, is trust in governments and regulators to deliver your social license. I think we probably don't need to dwell on that. It's patently not going to be the case in many environments where there's low trust in institutions. But we see that. I think we also often see people thinking that securing license to operate might be a function of benefit distribution, for example, or excellence in environmental management. And actually, we know now, and there's been some good empirical research done by people like CSIRO in Australia, including with us, that shows what the drivers of trust are. And it's things like people perceiving that they're treated with fairness, and that the engagement is high quality engagement more so than frequency of engagement, for example. So, treating people as you would wish to be treated as a neighbour yourself is important. I think we often find that when things go wrong at site level, there were often people at site that knew what the problem was and what the risk was, but not having the mechanisms to elevate that sort of quite unstructured understanding and data up to the right level where it can be properly managed. And I think that links to a final one we often see, which is that the people that really make our operations run are the general managers or the asset presidents, or different companies use different terms, and they have incredibly demanding jobs. But when you look at how they get promoted, they tend to get promoted for making good technical decisions quickly. That's the essence of a good general manager in a sense. And that's absolutely the opposite of what you need to get stakeholder buy-in quite often. So I think we're somewhat, letting ourselves down as an industry by not properly training that group of people who are going to become the general managers. Because once they become general managers or asset vice presidents or what have you, half their success will be dependent upon their ability to manage stakeholder issues, and they won't have been trained that in their metallurgy or their mining engineering courses, and they probably wouldn't have had a lot of exposure to it on their way up as they worked their way up in their career. So actually capacitating the people that are the leadership at site to address these issues, I think, is also really important, and not something we do a lot of yet.
Yeah, I think that's a really good point. And incentivizing them to think that that's important, to think about the other people outside of their organisation and the impact, and connect their accountability and being compliant with that. Yeah.
So you're sort of raising issues around training and organisation as well, communication through the organisation, and how people approach what they do. And I'm sort of interested in your thoughts, Ignacio, around bigger versus smaller companies. So obviously bigger companies have got more resources, but sometimes better structures internally, but they can be more impersonal as well. And I know that you work with companies at all ends of the spectrum, the IFC. Do you think larger companies do a better job of dealing with social license to operate than mid-caps or juniors, and if so, why?
Yeah, no, thanks, Tal. Yeah, and as you say, I think we cover the spectrum, so we finance both juniors, even at sort of some pretty early exploration stage, as well as people like partner with people like Anglo and some of the majors. And I suppose it depends is the answer. I mean, obviously from a capacity perspective, the majors have a huge amount of firepower. I think on the junior side, capacity is the issue in terms of the resources they have. And I think the key issue for us with juniors is particularly the ones going from exploration to development, that change of skill set and realizing and putting into ingraining the development sort of mentality into a junior is quite complicated. Usually you're with geologists and people who look at it very much from a technical perspective, but you really need to build up that capacity really early on, and particularly on the CSR and the stakeholder engagement front. They really need to take that on board. And if you have a CEO and a top management that really sees that, then obviously that can go very well. There are a few layers, so if a CEO and a board is really on top of those things can go very well, and we've had some good examples in our portfolio. I think on the major side, and I think John, you were alluding to it. I think I would call it sort of interface risks. So, as I think Daniel said, everybody at the top level of every organisation in the mining industry these days, embraces CSR and social responsibility, and it's all in the corporate policies, and and you've got great departments at headquarters trying to sort of see how you can do that. But at the end of the day, it's how does that trickle down to the asset owner? How does that trickle down to incentives? Because let's face it, at the end of the day, it's a schedule that when is the mine going to produce first ore, and and that is very often the driver of the incentives, the short-term incentives at least, of some of the staff. And so addressing those interface risks in terms of that cascading of ownership of CSR responsibility, I think that's the key issue, I think, in some of the majors. And how they address those issues of incentives and cascading of priorities.
And I mean, I'd agree with that. I mean, what the due diligence exercises we've done in the 10 years since I've been with Anglo American, we've seen juniors that have been led by fantastic people with real vision as to how to engage with communities and partner with local governments. And then you've seen some things which are just disasters in the making, and you walk away. And the challenge for big companies, of course, is you get more predictability, but how do you have those rapid channels? So we're doing things like mobile phone surveys in communities so that actually we can transmit almost on a weekly basis. We do them on a pulse, so once a month. We're doing it with our primary assets now. We'll get a pulse once a month, and one point of data is not necessarily massively useful, but it's the trends that we'll start to watch. So if something gets better or worse, we'll want to know why. And that will actually allow us to then go to the people who we know will know the answer, which will often be the general manager or the site social performance lead, and try and work out what's going on and react quickly. And we've got a few examples where we've now been able to do that, or where we've been able to spot the impact of changes. So it's for the big companies that have got strong systems, which have the benefit of being strong, but sometimes the disbenefit of being sort of inflexible. It's trying to build that rapidity in through the layers, so that you don't get caught through layers of reporting, for example, which is easy to fall into that trap in our sorts of companies.
And that also relates to difference between large developments or large projects and small projects, because obviously majors, many of the projects they do, and we've worked with Rio in Mongolia on the OT project. These are transformational projects for a country. And therefore very different type of approach to doing a small gold mine in the 13th gold mine in some other country. And so I think the big projects also involve a different level of engagement with government and a different level of expectation, obviously, from civil society and governments and the international community as to how that particular project is going to impact the economy. And we're talking about discussions about resource curse and a whole series of other things that the mining company inevitably gets drawn into. And so that's sort of another dimension of large versus small companies and how they manage CSR and the broader stakeholder engagement.
Interesting that you mentioned Tolgoi. Obviously, Rio bumped a few times into the government on that one. Just sort of interested, Ellecia, in your views around the sort of blurred lines between the license to operate and political risk. And obviously a big project like that sort of really comes into the national consciousness and can become a little bit of a political hot potato. So in terms of separating the license to operate and political risk, do you have any thoughts you could share around that? And separately, would you consider any countries in particular too risky to invest in?
It's a good question, actually. And when considering this question with an investment hat on, it's very easy to sort of default and associate some countries that are perceived to be very politically risky as being the higher risk in terms of license to operate. But I then think of a sort of market darling, for example, Australia, and when it almost threw the baby out with the bathwater with the super resource tax that it tried to introduce in 2010. And that really highlights to us that perceived low-risk situations are not always low risk. Now, whilst it worked out, and obviously the fact that Australia is the type of country that it is, a process ensued and saw that that didn't sort of progress. But it does remind us that not everything is always as it seems. The same goes, I guess, when you look at more politically risky countries and regions. And I guess I think of examples to answer that question, and look at Papua New Guinea, for example. Politically risky, historically, got volatility, yet there are sort of two big operations that have two very different stories. And I think the key difference when I look at them and compare them is the difference between one, considering all the factors that we've discussed today and that everyone's made on the panel, and the other not. So you've got oil search, which has been in the country since sort of 1929 or thereabouts, had a successful, long experience in the country, ticked all the boxes in terms of alignment, economic interest to the country, good cultural understanding and consideration of the people and stakeholders, and is still operating successfully there. In contrast, you've got the Bougainville copper mine, which was economically significant. It was almost 50% of the export revenue of the country in its time, and yet didn't consider the social impact of its mine, the environmental impact, and hence a civil war ensued and the whole mine was shut down despite it being one of the biggest sort of copper resources globally. And there are talks of it sort of being brought back, but it's been, I think, almost 40 years that it's been stalled. So you've got one country, yet two very different stories. And I think that case study really highlights the importance when considering political risk and licence to operate risk in the consideration of all the factors: environmental, economic, alignment, being compliant and accountable, and doing exactly what you say you're going to do, and thinking about all the others around you. And that really is the best way to ensure that, I guess, that you have a successful and pleasant experience. It's not guaranteed, though.
So in terms of sort of practical advice you'd have for companies that really want to understand the desires and needs and the priorities of local populations, so that they don't end up with people running around the pit chucking lignite bombs around, as happened in the example you alluded to, and sort of getting local communities on side. So what practical advice would each of you have for companies that are looking to start the right way and carry on?
Hire critical resources. That's a plug. No.
I think it starts with dialogue at a very early stage to work out, first of all, is a development in that location a tenable proposition? And there are places where we can't and shouldn't be developing. So every ICMM member, for example, has a commitment not to develop in World Heritage sites because, by definition, they're unique and irreplaceable. So, if it is a tenable proposition, don't then assume that it's a straight go, and actually trying to understand what it is that governments and communities and other stakeholders want. A mine very often is a significant opportunity for an upgrade in infrastructure, education, skills, etc. And that's how others will be looking at it. We obviously would tend to look at it from a narrower point of view, particularly when we're giving our investor presentations, but really trying to understand what it is that the stakeholders who will enable your success want from that asset. So we've done work on things like the Development Partner Framework with the Calonje Innovation Network at Northwestern University, which just sets out a simple mindset and approach to thinking about how you can frame the development of a new operation in a region. Now, and clearly that's going to be different, as Ignacio says. If it's the 40th gold mine in Western Australia, you don't have to do that. But if you're opening up in an area that's not familiar with mining, then it's much more incumbent upon you to do that sort of legwork and try and understand if people want you there, because if they really don't want you there, or if they only want you there on certain terms, you're better off knowing up front than battling through the courts and stakeholder protests, for 10, 20 years.
Just to add, I agree with everything that's been said. A couple of extra thoughts on that. One is, I think that one should not underestimate, or companies should not underestimate, how hard it is to really understand what stakeholders are thinking, and including community groups. And if you imagine that, particularly in mines in remote locations where there's sort of indigenous groups and other I guess, non-industrialized societies, the whole discipline of anthropology and ethnography, you'd have an anthropologist go to a community, live there for 3 years, write up their dissertation, and then say something like, well, I'm still not quite sure what this was all about. But yet a mining company, or for that matter, an oil and gas company, is having to, often within a few months or even sometimes a few weeks, trying to work out whether the community wants them there, to John's point. So don't underestimate how difficult it can be. And secondly, linked to that, is talk to as many people as possible. So often in our work with clients, they've talked to some stakeholders and they've got assurance, say from the government, that the country wants them there. They've got assurance from certain members of the community that the community wants them there. And then in one particular case, a client made a very, very substantial investment, several $100 million, only then to discover that the community in general was actually opposed, and they blockaded the access route, and they basically could not develop this project that they'd spent a lot of money on. The reason was that the community members that they'd spoken to when they were doing the due diligence were a small number of so-called community representatives who'd been set up, meetings set up for them by the company selling the asset, and these community representatives were the recipients of the community social investment, and they were seen by the base of the community basically to have been co-opted or corrupted by the company. And the reality was that the base of the community really didn't like this company at all and saw it as quite a sort of corrupt and not particularly beneficial entity. So that there's just an example of huge loss of commercial value by not talking to enough people.
Yeah. I think in our observation and advising clients, whether you're wanting to raise money or connect with strategic investors or connect with the country in a strategic sense, it's really simple, but I see it a lot, and we're guilty of it as well. The importance to ask, to listen to the response, and then to act accordingly. I think we sometimes tend to look at things through our own blinkers and forget that engagement, and that's definitely the most consistent thing that I would say is the piece of advice that I would give in terms of success.
And the smarter people are, the less good they are at listening generally. So
yes.
We do an exercise on a training program we run where we give people 4 simple bits of information in a story, and then at the end, and people are just making all sorts of assumptions about, so we ask them what did they want, and actually during the whole story nothing was asked for, and then people are immediately they want money, they want jobs, so particularly professionals and the sorts of professionals that end up running companies and large organisations are good at sort of making deductions from different bits of information, and that can be pretty fatal in those contexts.
Yeah, agree.
What about sort of the use of technology in sort of capturing the right information to make that initial assessment? You referenced mobile phones, which are sort of now ubiquitous. Pretty much everywhere you go, people have them now. Are there ways in which technology can be used to better assess what local populations really want? Or is it more of a curse technology, such that you sort of get this echo effect and fake news spreads more easily? Interested in any of your thoughts on that.
Well, I think it's, technology and look, I think generally speaking, I think the world has been trending towards more open societies, generally speaking. There have been some reversals in that, but anyway. And I think the increase in sort of mining community conflict, you could argue is part of that. You could argue that, mining companies are, the mining industry as a whole is doing or at least trying to do a better and better job. So you can't sort of argue necessarily that it's because the mining industry is getting worse in terms of dealing with these issues. So what can explain that sort of increased level of conflict? And in a way, you could argue it is a more open society, a more open political sort of environment, and that's to maybe not a lot, well, to a large extent, I would say, down to technology, to internet, social media, to all these things which allow international NGOs to sort of weigh in more, communities to take more collective action, and a whole series of things. So there's, and you could argue that can be positive because it gives a platform, but it can also be manipulated by certain actors, and so look, I think it's as you say, it's both an opportunity and a threat, and what you can't do is ignore it. So I think as a mining company, you have to have a strategy around social media and communications. And I think one of the key sort of conclusions for us in how to manage all these CSR things is transparency and I think open dialogue. And so if you can use that social media and internet to establish that, then I think that's a great positive. But
I think technology undoubtedly has made once remote operations very visible to everyone. And I think actually, on the whole, I think that's a good thing. Similarly, there are technologies we can use, I referenced mobile phone surveys, for example. So and I think they can help, but actually, although we're investing a lot more in making sure we've got properly capacitated teams at site level who can manage the issues, who can form the relationships, and investing also in the general managers to make sure that they are given a chance to acquire the skills that are required to manage sites in complex socio-political environments. So I think technology has a role to play, but it should be seen very much as enabling the development of effective relationships. And if that means that it's just allowing us to respond much more quickly to things as they start to bubble up, that's useful. But there's, again, the research I mentioned that CSIRO, from Australia have done shows very much, it's very clear. It's about the quality of engagement. It's about a sense of procedural fairness. And technology can help with that, but fundamentally that's about relationships between people.
Just sort of diving a little bit further into the issue of fairness and thinking, we've talked a lot about just now sort of local stakeholders, and at the higher level, certainly the previous speaker referenced resource creep, tax creep, and that sort of effect where as commodity prices creep up, so do governments' hopes and aspirations to take more share of the pie. An executive recently said to me that mining companies are designed to be extorted given their massive sunk costs, and obviously mining companies don't vote. So perhaps Daniel, could you give us some thoughts around what you think mining companies should do to sort of protect against government attempts to capture more rent from the resources than they've initially agreed to?
Sure. I think there's no easy answer. As you said, that once the investment's made, the balance of power between the government and the company shifts. You also mentioned these two quite interesting examples in recent months. Ellecia in Tanzania, Freeport in Indonesia, where the effective governments have moved quite substantially, and in Tanzania, a very dramatic way against the companies. And I think part of this stuff is just exogenous. You can't really help it. But in my view, there's a tendency within the industry that when the governments move against the companies, it's just like, they just don't understand. It's terrible for them. The industry will say it's damaging investor confidence in the country. They've gone a bit mad. The Prime Minister or President of this country has gone a bit mad. I caricature a bit, but we hear that sort of stuff a lot. Now to a degree, that is true, but I think it underplays the extent to which companies, by being very proactive in both ensuring that they're bringing the right sort of benefits to countries and to communities and communicating that, can reduce, if not extinguish, reduce the risk that the governments are going to move against them in a substantial way. So in the case of Tanzania, it's quite clear that for quite a few years, a very, very deep-rooted perception had built up in the country that the mining industry and the gold miners in particular had been failing to benefit the countries sufficiently. And it's without doubt also the case that the tax terms that the companies initially got in Tanzania to get them to invest in the first place were very, very generous. Now, the question is, would a forward-thinking mining company have wanted to voluntarily surrender at least some of the fiscal terms, made a big deal about that in media and PR terms by communicating, look at what we're doing voluntarily. But I'm not saying this would have removed the problem in Tanzania, or for that matter in Indonesia, but I do think it can take the wind out of the sails of a lot of this sort of populist resource nationalism that tends to build up when companies aren't paying enough attention to these sort of issues.
It's a little bit of short-term pain for some long-term gain.
Potentially, yeah.
And if you step back and look at sort of the theory behind mineral resource rent taxes, I mean, when prices are good, as companies, we would want the tax regime to be such that governments are taking more, because we would prefer, on the whole, that although we understand the case for a base load of royalties for governments, actually it's better for the industry if most taxes are profit related. So you would expect actually governments to be taking more tax when things are good. I think one of the problems, as Daniel says, is we tend to fix the tax system for the here and now, and it's not just Tanzania. I mean, I think the last UK budget last week was the first time I can't recall hearing a change to the UK North Sea oil tax regime. They change it every single year normally. And I think what we want as investors is an understanding that there's stability, and if that does mean that we get less when times are good, that's fine, but at least we then know on what terms we're investing, and I think that's what investors, and actually if the terms aren't attractive to us, then we can go and invest elsewhere, and the holder of the tax policy can consider. But it's that unpredictability, and there are a couple of countries, and I won't name them, but as soon as the copper price goes up, there'll be motions in Parliament to take a bigger share of the tax take or bigger free carry on projects, and it happens almost every time the copper price goes up. So, and nobody's going to invest on that basis. But on the other hand, nobody's going to want investment when you don't get any tax take when the companies are clearly really doing well. So I think there's a need to have a mature debate around tax that works at the top and the bottom of the cycle for both parties, more or less.
I think in the case of the capex risk, it's a really good point. And in situations where mines are already developed or that money's already sunk, it's obviously difficult to do this in retrospect. But looking forward, if there's a way you can align the government with that capex investment, even by way of a convertible in terms of them being rewarded later on in a capacity, structuring it that way, I think that's a way to help minimise the risk of you sinking all this money into something and then essentially changing the rules and reaping the benefits later on without consideration of that capital.
This is a way to magically transport the mines out of the country.
Yeah. I mean, just to say, from an investor perspective, as IFC, what we try to do before investing in some of these projects, actually, we always do, we present to our board as part of the investment decision sensitivities on fiscal take, on different commodity prices, and try to assess whether we think that's fair. On both for the company but also for the government. And to the extent that it isn't fair, then obviously that raises red flags that this can be renegotiated if commodity prices go back to a certain level. So I think that's before going into investment, that's key. The other thing that we've now asked all companies that we invest in to do is to publish the full concession agreements, any other agreements with the government, to the extent they haven't already been published. So again, there's full transparency in countries. So before the company decides to sink in a few $1 billion into the country, that there has been a valid public debate about the terms of that concession out in the open. So rather have it up front than have it once you've sunk in the billions of dollars. Now that doesn't prevent the country from renegotiating down the line, but it at least reduces the risk, and that's something that we think is important.
I'm going to stop you there. We've got a couple of minutes for questions, and no panel would be complete without some questions from the audience, so this is your chance. If you'd like to ask anything of the panel, please put your hand up and fire away.
Hi, good morning, Donald Bray. I really appreciated this discussion this morning, so thank you for coming out. The question is for the panel, but I guess specifically to Daniel. I really appreciate your comments specifically. As an anthropologist working in the field with mining companies, I can assure you and the audience that it does take a long time. It is a great deal of effort to understand how that local system works. Your comment about broadening out the discussion to include more people beyond the community representatives, the local headmen, etc., how do you recommend to your clients to do that?
Thanks for the question. Well, it's creating, first of all, sufficient time to do it, because obviously the more people you speak to, the more time it takes. Secondly, as much as possible, doing it through independent parties, because they'll, if the company is there undertaking the research, they will hear certain things, or certain requests will be made by the whether the stakeholders that may not reflect what the stakeholders really think. So some sort of respected independent third party, and having a, I guess it's partly around a good sort of anthropological research, having a good sense of the structure of the community and who it is, so that you won't have time to speak to everyone, but having good representatives from different segments of the communities, male and female, and different generations and different geographic regions. So no simple answers, but we don't always do work in a transaction situation, but a lot of our work is in part of the due diligence process, where the time scales are really tight. So this is almost impossible to do, but it's certainly, a lot of companies do it in such a superficial way. It's not hard to do it better than is often done, if that answers the question.
Indeed, thank you very much indeed.
Good morning, my name is Raziel Zisman. I run a private mining company, but I'm also involved with Whittle Consulting. My question is as follows. When we talk about the acceptance, are we talking about just the wedding, or are we talking the life of the marriage? Is there anywhere in the world where, for example, the government and the companies and the communities, all the stakeholders get together and create a committee that looks after the project through the life of the project to deal with all the issues early as they come around? Because assuming as a developing economist, mining projects and governments and communities should all be aligned. You cannot sort of put ketchup on the communities as CSR and make sure the thing tastes nicely. It's got to be transparent and upfront. Can you please comment on that? And last night I was at an event when a very interesting issue came up. You have a mine that runs for 30 years. The technology will be very different 10 years from now to exploit that mine. The economics will vary enormously. So this whole idea of, it's like in Chile, the DL 600 that you have for 30 years, fiscal stability, if the technology changes, if parameters change, is there an interest in having flexibility in the relations as long as they're transparent and upfront?
Shall I give it a shot? So I think some of the things we're talking about have been emerging thoughts. I mean, when I look at our business, I would say the partnership that De Beers has with the government of Botswana has sort of become that sort of relationship. It started off as a 50-50 JV right from the beginning. Botswana government have always paid their share of the capex, for example. And I think through that, there's a way of working between the government of Botswana and De Beers, and then the operating company, Debswana, which is the JV, that starts to look a lot like that. I think at our Quellaveco copper project in Peru, for example, we've had it quite some time, but we went into a dialogue table process 7 or 8 years ago, and in fact, IFC was an investor at the time. And that did start to look at the mine in its regional context, and we will sort of look to refresh that work, and there were a series of commitments we made. We actually weren't really about mining, they were about things like irrigation. So it was an area where there was plenty of seasonal rainfall, but there was very limited storage capacity, and that significantly hindered agricultural potential. So one of the things we did was actually significantly invested in water infrastructure, which suited us, but it has also created opportunities for expanding agriculture. So I think we're starting to see some of these approaches, and as I mentioned before, we've been involved in a piece of work led by Northwestern University called the Development Partner Framework, which kind of sets out a mindset. It's not a blueprint, it's not a template, but it's a mindset about how do you actually start to think about a mine, as you say, as sort of a collaborative regional development project, and use the resources that the mining company can bring in, whether it's for 20 years or 40 years. And the benefits we bring them in, they end up fundamentally being in 3 buckets, don't they? It's sort of jobs, the procurement, and the taxes we pay. There's other stuff that's fundamentally the benefits. And they will have different profiles under different technology scenarios as well. So you've got to make sure you've got a balance of those benefits. Don't just rely on jobs if technology is going to take jobs out. Don't just rely on a high tax take if it's a low margin mine, for example.
Sorry, we've overrun somewhat. We've got people doing this. So I think we'd better call it a day there. Perhaps to summarise, this is important. It's important to think broadly and holistically about it and to be fair. So with that said, Hopefully you guys will be around to answer any further questions people have, and thank you all for listening.